Hello and welcome to Term Sheet Clinic. Now, many of you are familiar with our hugely popular pitch deck clinic where we sit with a founder, go through their pitch deck together. We thought we'd have a look at term sheets. Now, of course, term sheets are confidential to both the company and the investor, so we couldn't just take anyone's term sheet. We made one up, and we made up the nicely named Helpful Ventures. So Helpful Ventures is going to invest £500,000 roughly. So this is your typical seed rounds. So over the next 20 minutes or so, we're going to dive in and imagine you're a founder and an investor has sent you their term sheet. Now, in the UK on angel seed rounds, normally the founders use SeedLegals to create the term sheet. We take them through all the key deal terms and they send the term sheet to investors. But when you get to later stage rounds, investors will often send you their term sheet. And so what you're going to do is you're going to analyze the term sheet, look at all the terms they want, and then dial those into SeedLegals to create all the deal docs. But what do those terms mean? So let's take a look at the term sheet that we've received from Helpful Ventures. Now, since we had to make up this term sheet, we thought, should we go crazy and make the term sheet from hell? But actually we thought we'd make something that's kind of typical that you might receive. So to dive in, we start with Helpful Ventures telling you how wonderful you are, how they're going to be awesome. You can skip that. That's standard gumph they put in every term sheet. Move right on. So the next thing is probably the most important thing in the term sheet, which is the investment and the valuation. So often you will have in mind a nice big number and a VC will send you a term sheet with a smaller number. But that's obviously one of the key things to negotiate. One thing to be super careful of on the valuation is we always at SeedLegals suggest you talk about pre-money valuation. That's the valuation before the investment. Some funds will send you the post-money. You think it's a bigger number, but you need to subtract the size of the investment. And if the investment changes, that post-money number changes. There's nothing wrong with post-money, but we recommend pre-money. So the next thing is the total raise. So here, an investor may be up for taking half of your round, and they're expecting you to fill out the other half of it. But what if you don't? Will they bail? Will the round fall apart if you can't take the rest? So that's something to be careful of, to know, and maybe talk with your investor. If I can only get half of the remainder, are you still in or not? So the next one is, what shares would the investor like? Now, if they're up for SEIS or EIS, they'll normally be looking for ordinary shares. And if they're smart, they might ask for a 1x liquidation preference A ordinary share, which you can set up on SeedLegals. If they're a fund, they'll probably be asking for preference shares. And they may dress that up slightly by calling them seed preferred or series seed or something. But if it's a preference share, that means they get paid back their money first on an exit. So is this good or bad? Well, the good news is in the UK, because of SEIS and EIS, most funding rounds, investors just get ordinary shares. So if you sell the business, the sale profits or the sale assets are divided between everyone proportional to the number of shares they have. But if the investor is getting preference shares, that means they get paid back first. So if you sell a business for 100 million and you've raised $1 million, the investor gets back their $1 million and you divide the rest of it between everyone. That's fine. But if you've raised 5 million and you sell the business for 5 million, an acqui-hire, the investor gets back the 5 million, you get back nothing. So pref shares are something to be careful of. The more you raise with preference shares, the more you have to be aware. If you have a low exit, the founders may get little or nothing. So the other thing to know is whether the preference shares participating or non-participating. Non-participating means the investor can choose, do I get my money back, or does it get treated like an ordinary share and I get split? Participating means I get my money back first and then we divvy up the rest. So participating is double dipping in a sense, and you should push back and ask for a non-participating. Now, the investor might also say, I'd like to get double my money back before you get yours back. And that's called a 2x liquidation preference. And it used to be fashionable years ago in the bad old days of VCs. Thankfully, that's almost completely a thing of the past. But if investor asks for more than a 1x, be sure to push back on that. So the next thing is the option pool. So the purpose of an option pool is to dilute the existing shareholders so you can give options to your team without diluting the new investors. And investors will often ask for that, or in fact insist on it, because they don't want to be invested right off. They don't want to be diluted right after the round. They want the founders to be diluted up front. Now in America, there's often an expectation for a 20% option pool. In the UK, a 10% option pool is the norm. Remember, if you make an option pool that's too large, the founders are just going to dilute themselves, and if you sell the business before all the options have been granted, then all you've done is unnecessarily dilute yourself, because the assets go back to everybody out of what was originally your shares as the founders. So my suggestion is create an option pool that's large enough to last to the next round, but after that you can increase it as needed. Okay, the next thing is the investor director. So when there's an investor, are they going to be fire and forget? Here's my money, awesome, call us on an exit. Or do they want to micromanage your business? And that for founders is really the biggest problem after the valuation to solve, which is, am I going to lose control? Can the investors fire me? So what you want is you want the founders ideally to control the board. You want the founders to have more than 50% of the shares. But actually, to be fair, the investors have to have some say in the company. And that say is expressed through one of two means: an investor director and or investor consent. So investor director says, I would like a seat on your board. And if someone's investing 20K, unless you really want them on your board, the answer is no, that's not appropriate. It will make it harder for me to raise funds later, because how will I get rid of these early investor directors when I really need to give that position to someone later? But if there's an investor VC, very likely they're going to want a board seat, and they're generally going to want investor director consent rights as well. So on a 500K plus round from a fund, you can probably take it as read that there'll be investor director consent. And ideally, you should only have one such investor director. You may find yourself in later stage rounds with more than one, but in any event, the founders should always outnumber the investors on the board. Otherwise, you may lose control of the board, which you don't want. So the next thing is the investor majority. So certain company decisions need, without investor majority defined, would need a shareholder vote. But the founders own most of the shares in early stage rounds. In fact, before the first round, they own 100%. And after the first round, they might own 80 or 90%. So if the founders could just approve everything themselves, they could do all sorts of crazy stuff, change the business, issue more shares, sell, whatever. So the investors came up with this new concept called investor consent. And investor consent says for certain decisions, you also need the buy-in of, let's say, 50% of the number of investors by amount of shares they own. So if you're raising 150K from angel investors, our data on SeedLegals shows maybe 25 or 30% of the time there'll be investor consent. If you are raising £1 million, our data shows almost 100% of the time there'll be investor consent. So have a look at the SeedLegals resources deal data section, and you can see the spectrum by size of raise to see, are you an oddity, or actually realistically you should give that. And here they've asked for 50% majority consent, which is pretty standard and not unreasonable in a round of this size. So now, when it comes to the investor consent, often a term sheet from the investor will just go, subject to the normal consents, which really isn't very helpful. On SeedLegals, in our term sheet, we list the consents. So here, for the purpose of this, I've listed the kind of consents that they might be asking for. And you should read this very carefully. What you want is you want to be able to run your business. So on a daily basis, the CEO can do stuff. You can hire someone, you can buy a new coffee machine, you can close deals, whatever it might be. Bigger decisions, you're going to go to your board. If you want to hire someone for £200,000 salary, you need to go to the board. Certain things you need to go to your investors. But you don't want to be hitting up your investors to go, hey, Bob in accounting is going to get a salary raise. Are you okay with that? And we need to subscribe to Amazon for another year. Are you okay with that? So you want to set it up so that little things the company does not need investor consent for, but really big things like a new fundraise, selling the company, entering into litigation and so on may reasonably require investor consent. So read that list if it's in the investor's term sheet super carefully, and hit us up on SeedLegals to ask about any things that just jump out. So the next thing is founder vesting. So as a founder, great, I own all my shares, and now the investor's saying, wait a minute, I have to start a vesting schedule. If I leave, I have to give some of them back again. Why would I want to do that? But as the investor, the last thing you want to do is the founder goes, yeah, on paper I'm a millionaire, I'm just going to sell out. So the investors will almost always ask the founders to have a vesting schedule. And there we see two patterns, which is either 3-year straight line vesting, starting from completion of the round, which means if you leave any time in the next 3 years, you have to give back some proportion of your shares. But the other pattern is 4-year vesting with the 1-year cliff. This means if you leave any time in the first year, you lose everything. After the first year, you get 25% immediately vested, and then it goes up from there. So, which is right? I think what makes sense is super early stage companies that incubators and accelerators invest in, they know there's a good chance the founders will split up. Maybe a 20% chance they'll split up in the next year or two. What you don't want is you don't want founders being around for a few months sitting with baggage on the cap table. So there it makes sense. Team, you're either in or you're out. This is pushing people together. But if you've been your heart and soul in the business for the last 3 years, you're not going to want to risk losing everything. So there you're going to insist, in fact, the opposite. You're going to say, all right, I'll do some vesting, but 30% is already vested up front, and the rest will vest over 2 years. So have a look carefully at the vesting the investor is asking for. And if you're super early, they're going to pretty much get what they want. And if you're later stage, you're going to push back as to what is reasonable for the effort that you put into the business so far. So the next thing is drag along and tag along. And investor term sheets will normally say subject to the usual drag and tag, which is probably okay. So what does drag along mean? And is it a good thing to give investors? And the answer is drag along means if the majority of the shareholders want, by number of shares held, want to sell the business, then the minor ones are dragged along. So this is a vital thing to have, because without it, it means that there's some minor shareholder is like holding the customer, the company hostage. They're saying, you're going to buy me out for 10 mil or I'm not selling. But no. So drag along is essential to have. But there's a catch, which is here you can see drag along is set to 50%. Now, on your first round, the founders might own 80%, but by the third round, you might be down to 50%. And if your drag along is set too low, you may find that the investors can get together and decide to sell the business, and the founders then get dragged along. So this 50% number is probably okay if this was a first round and the founders have got 70% of the shares. But if this was your second or third round and you had maybe 60% of the shares, you would want to make sure that this number was higher, and you would go for a 75% drag along. The other thing to note is that normally founders are assumed to hunt as a pack. You're going to act together. But what if there are 3 founders and one of them decides, meh, I want out and to sell? So think about carefully the drag along. It's essential to have, but it's set it too low, and as the founder, you might be dragged along. The next thing is co-sale. So co-sale is when a founder wants to sell out themselves. You might, the investors reasonably go, well, you're out, I would like to be out as well too. So investors will frequently ask for a co-sale right, saying that they can sell their shares alongside yours, which is okay. I mean, you think it's kind of reasonable and there's nothing bad about it, but be aware it adds friction. So if you want to sell your shares, great, I'm going to sell you 1,000 shares. But you can't make that offer to somebody because you're going to go, wait, I think I can sell you 1,000, but I need to shop it around first to find if anyone else wants to match it. So you either have to buy 1,300 or maybe I can only sell you 700. It's kind of difficult to operate in that way. So co-sale is reasonable but comes at a cost. So now preemption. So preemption means if you are issuing new shares, this is preemption on offer of new shares, then other shareholders have the right to buy more. And that's basically a statutory right. So you're never going to have anything other than that. And that's vital for investors so they can have skin in the game as you become this unicorn later. But sometimes investors sneak in things in this wording that give them the sole right to invest in your next round. And that's something that's really dangerous. So make sure that they don't have a right of first or only offer or something like that, because that can cause you great problems later. It's hard to raise investment when someone makes you an offer and you go, well, I don't know if I can take your offer because I need to see if my existing investors want to actually take it instead first. Your new investor will go, why would I bother doing all the due diligence on your company if at the point I'm ready to commit and you're ready to commit, you tell me, no, I can't go ahead. So this will almost certainly lead to friction in your next round if you do anything other than the basic preemption on issue of new shares. So the next thing is information rights. So here, the investors ask for monthly management reports, which is okay. You'd probably want to push for quarterly because it's a drag to do this monthly. So quarterly board meetings are about right. You'll find that monthly updates are going to kind of annoy you after a while. Every few weeks you have to sit there preparing these stupid reports to send to some investor who's going to read them for about 30 seconds, if at all, and then hit delete. So try to push for quarterly if possible. Some funds will insist on it, but c'est la vie. If it is going to be monthly, make sure that they're really quick things. You just put together your latest, KPIs and send it off. You're not forced to make a big, board pack each time. So the next one is the founder salaries. So here you can see the investor is trying to be super nice. We appreciate you putting insane work. You get 40K salary. Now, you can also hit us up on SeedLegals resources deal data to see what founders' salaries are like at different round sizes. But 40K would be about right for sort of 150K SEIS round. If you're raising £1 million, you'd be more at the 60, 70 or 80K potentially area. So this might make sense in an earlier stage, but here, for this size round, you're probably going to struggle to live on 40K. You probably want to go for a slightly higher salary than is being proposed here. So the next thing, which is really, really important for founders, are the leaver provisions. So if you leave, either you're a bad leaver, which means you're fired for misconduct, or you're a good leaver, which means you die or you become too ill to work, or you're a voluntary leaver, which means you get bored and disappear off to Google or somewhere else, or you're a forced leaver, which means you're forced out of the company from no real fault of your own. What happens to your shares? And generally, bad leavers either lose everything or at least lose the unvested shares. With a good leaver and a forced leaver, you have to think carefully through. If I leave, I want to keep all my shares. But if my co-founder leaves, bastard, they need to give their shares back again. So it's like a 2 or 3-sided game where the investor wants you to give back as many shares as possible if you leave. You want to keep them, but you also want to make sure if your co-founder leaves, you're not stuck with a lot of the company non-performing on the cap table with potentially an unhappy co-founder afterwards that's out. So read these carefully, and what you see here is bad leavers sell unvested and vested at nominal value, so you lose everything if you're a bad leaver. Good leavers sell their unvested at nominal value, which sounds right, and they're vested at fair value. So there's a little trick with fair value. You're probably thinking fair value means the fair value of the company, but fair value is the value a company agrees with an assessor. And if one of the founders has just left, then the company or the investors can manufacture scenarios that have the fair value set at pretty much zero. The company's got no revenue, it's loss-making, and founders left, and you might think you're going to sell your shares at £1 million or 5 million valuation, and it turns out you get nothing for them. So be very careful about agreeing to fair value things, because fair value may not be what you expect it to be. So the next thing is we'll skip the share transfers. So share transfers is if you want to sell some of your shares, or any other investor or shareholder wants to sell their shares. Is it frictionless to do that, or do you need to get all sorts of consents? So again, double-edged sword, like many things. Everything's a complex set of checks and balances. If you let anyone freely sell their shares to anyone, sounds great. But imagine your co-founder joins a competitor and sells shares to the competitor. That's a disaster. So you want to have some checks and balances, but not too much. Otherwise, you find no one can sell their shares. And then there's no value, and then investors don't want to invest. So the next thing are the warranties. So when you raise investment, you're sending a pitch deck and a business plan to investors, and they're investing based on promises that you make. But what if you've lied? Or what if you've just been negligent? What if you've forgotten to disclose you owe £300,000 in taxes and there's a lawsuit and you don't own your IP? Then how will you deal with that? And that's where the investors say we can claim against the company and or the founders if there's a misrepresentation. So you want to be careful to limit your own liability so they can't claim against you. And here, the founder's limitation on liability is a massive £150,000. So unless you have £150,000 in cash lying around, that's not good. On SeedLegals, our suggestion is the founder's personal liability is around 10% of the amount the company's raising, split between the founders. So this might be more like £10,000 to £20,000 is reasonable. So signing this term sheet, if things go pear-shaped, could be a really expensive mistake for you. So we'll skip the dividend policy, because that's probably everyone gets dividends, there's nothing to see there. The next thing then is the arrangement fee. So sometimes, ideally the investor says, well, invest, you don't need to pay us anything. We get shares, you get money, that's it. But when you get to the end of the term sheet, beware the hidden gotchas. So often with an SEIS fund, they make their money partially on an exit of your business, but partly on management fees or arranger fees. So here the investors ask for 2%. Well, it's not going to kill you. It's a bit annoying. It's like going for dinner with someone and the other person isn't picking up their part of the tab afterwards. It leaves a bit of a sour taste, unless you know up front that that's the model by which you're engaging with them. If they're asking for 10%, serious problem. 5% for a fund that's arranging investors might be about par for the course. But in general, a VC, you would not see them taking any slice off the top. The next thing now is exclusivity. So the problem is, by signing this term sheet, you cannot talk to anyone else for 120 days. It's insane. The investor can dick you around for the next 3 months, 4 months, and you're screwed. So what you want to do is never really go for any more than 45 days exclusivity as a maximum. Try to get to 30 days. And of course, be aware that during this exclusivity period, you can't be shopping it around to other investors without the consent of this investor. And that's really a serious thing to think about before you sign a term sheet. So the next thing is Keyman insurance. So the investor wants to make sure if the founders die or something, maybe the company gets paid something. If they are a director themselves, they would like you to have directors and officers insurance. Now, these are not hugely costly things, but Keyman insurance might cost a few £1,000s. Directors and officers insurance might also cost a few £1,000s. If you're raising 150k, forget it. You don't need to do this. If you're raising a few million, actually it probably makes sense to do. I'm not sure about Keyman, but certainly anyone who's a director of the company is going to want to be protected. So that then takes us to the last thing, which is the fees. So unfortunately, investors usually want you to pay their legal fees, which is a bit annoying because it means they can faff around, rack up huge legal bills, stuffing around with the documents, changing stupid words unnecessarily, and you're going to pick up the bill. So to discourage that, of course, you want to try and reduce the size of the cap that you'll pay the investors' legal fees, and ideally get them to pay that themselves. And then, of course, we get to the last point, which is 7 days that you have to sign this. So the clock's moving fast. They would like 120 days that you can't shop this around, and you have to agree in 7 days. This means, having received a term sheet, you have to rustle up your other investors that you're talking to in a hurry, because you either have to commit here or you have to say sorry. If you say sorry, yeah, will they disappear? Probably not. You can ask them to say, listen, you still need to do some more DD or some work. Can we extend this? As my business partner says, when it comes to doing a deal, everything's a negotiation. If you have any questions, hit us up at SeedLegals. That's what we're here for. We've gone through an example of a reasonably typical term sheet for a seed stage round or even an early Series A round. I hope this was helpful. Lots more at SeedLegals.com, resources, deal data. Thank you.